Hands up, who here would class themselves as a business owner? So someone either owns a business or is running a business for someone else. Who here would class themselves as a property agent, so letting agent or estate agents? Okay, good. And who here is a landlord? Excellent. So that's really helpful because today's presentation has been pulled together for a mixed room. So today I will be covering Making Tax Digital, which will then lead on to decision making and strategic planning. I'll then talk about wealth planning and whether you should put your property in a limited company or perhaps a limited liability partnership. And finally talking about selling a business. So I'm going to make a promise to you that today's presentation is either going to be the best presentation you've seen all day, the worst presentation you've seen all day, or somewhere in between. And that's my promise to you.
Never seen mine yet.
So just a quick overview of who I am and who A4G are. I'm Mitch Ewer, I'm a qualified chartered accountant and I've worked for A4G for 15 years. I specialise in working with landlords, letting agents and property focused businesses, helping them navigate an increasingly complex tax environment. And A4G is a proudly independent firm. We've been established for 31 years and we've got 7 partners, but unlike most firms in the market, we're not backed by private equity or going for an acquisition at the moment. And that independence really matters to us because our focus can stay on providing advice and long-term relationships with our clients. So please note that today's presentation is for educational purposes only and it's not specific tax advice. Because specific tax advice is based on your own specific circumstances. So please do speak with your accountant, and if you need a new accountant, please speak to A4G. So let's start with Making Tax Digital, or what we're calling the rise of micro-compliance. Because HMRC are moving closer and closer to real-time reporting. We've seen this happen gradually over a number of years. We've seen PAYE, VAT, capital gains tax, and now Making Tax Digital for income tax for the self-employed individuals and landlords. And then from next year, we're going to see P11Ds, benefit in kinds, move to an annual process rather than at the end of the year. So the direction of travel is quite clear from HMRC. They're wanting regular reporting, digital records, and no more surprises at the end of the year. So those that are affected by Making Tax Digital are going to be individuals with combined turnover from their rental income added together with their self-employed income exceeding a threshold. So for the 2026 threshold, whoever submitted a tax return for 2025 and was over the £50,000 income threshold will first of all be called. Then from next year, that threshold will drop to £30,000, which will mean that more landlords and self-employed businesses will then be called. And then from 2028, the threshold drops again to £20,000. So what does that mean in practice? It means quarterly updates of your income and your expenses needing submitting. And the first period has just finished recently, last week, and that is going to need to be submitted by the 7th of August. It's then followed by 3 more submissions throughout the year, followed by one final 5th submission, adding everything together. Now that's going to force people to keep digital records and stay on top of their numbers throughout the year, rather than leaving everything to January. So I've got an action list here on screen, and we've got a website that we've set up to help landlords help themselves. Because although we can help our clients do all of this, all it's going to end up doing is eroding landlords' profits. So our aim is to help you help yourself. Do speak with us if you need further advice on this. So now, once we're doing quarterly submissions and you've got that level of visibility through Making Tax Digital, the next question stops being about compliance and starts becoming about decision making. Because now you can actually tell what the numbers are telling you. So I'm going to make you another promise that I'm not just here to spread doom and gloom, but rather to bring awareness so you can take action to protect your business. Because let's face it, the last 6 years have been brutal. In 2022, we saw inflation hit 10%. And although the rate of inflation has come down closer to the Bank of England's target of 3%, prices have not come back down. They just continue to rise at a much slower rate. On top of that, we've seen limited companies since April 2023. Corporation tax has increased from 19% to 25%. Now, on the face of that, that looks like a 6% increase, but it's a 30% uplift in the tax rate itself. That just ends up squeezing margins, adding more fuel to the fire, and leaving many businesses feeling vulnerable. We've seen minimum wage increase for over 23s as well, from £9.50 to £12.71, which is a 34% increase. And the important thing is that it doesn't stop there with minimum wage workers, because once the bottom rises, the rest of the pay structure has to follow, so that you can maintain the gap between junior and senior members of the team. Then you need to factor in employers' national insurance, where we've seen the rate increase in national insurance and the threshold at which you start paying it also reduced down. So in practical terms, that just means it costs more to employ the same member of staff than it has a few years ago. So if you take an example of someone who's paid £25,000, it now costs £4,000 to £5,000 more to employ that same member of staff. And that's a 20% increase there. Now let's work through an example. If we've got business turnover of £250,000, paying corporation tax previously at 19%, leaving profits available for the business owner to draw of £50,000. We take that forward a year with 10% inflation. Now the business owner is going to want to draw out more to keep up with the cost of living, so their income needs to go up to £55,000. Factor in corporation tax of 25%, and now turnover needs to rise to £293,000. Jump forward 3 more years with an additional 3% each year. Now the profits are £60,000, 25% corporation tax. Your turnover now needs to go up to £320,000. So that's a £70,000 increase in your turnover, or a 28% increase just to stand still. So hands up here, who would have put their prices up by 28%? So not surprisingly, I've not seen many hands go up there. Who was even aware that they needed to put up their prices by that much? And that's the problem. Business owners are not being made aware of this. So I've got one more question for you. Just imagine that your business has a March 2026 year end. You submit your accounts by December 2026. That's the first time that you're being notified by your accountant. You could effectively be 21 months late in reacting to needing to put your prices up. And if your drawings increase because of the cost of living, but your turnover hasn't, well, then you've effectively spent your tax money. So one final question, who can now see how important it is to know your numbers? I'd see some hands go up there. So what can you do about this? This is where you start to form a plan. So I like to keep this really simple with a 4-point action plan. So you start with, where do you want to be in the future? Now, in the future, it might be that you want to be spending 4 days in the office and 1 day on a golf course. Then you need to look at where you are now. And as one of our clients famously put it, it might be that it's a bloody shambles. Then you need to know what you need to get you there. So to know where you are now and what you need to get you there, we believe that's where management accounts come in. So management accounts, unlike year-end accounts, which are basically for HMRC's benefit, management accounts are for those that are running the business. They're either going to be monthly or quarterly, and they should be able to give you an idea of your performance, your position, and your financial health. Then you can then react and make decisions throughout the year rather than leaving it until later on. Now, some people that get management accounts, they're either at 2 extremes. They're either getting lots of fancy graphs and tables that no one's explained what any of it means, or they're getting exported data from their system with missing information such as missing payroll journals. And the problem is that no one's taken the time to fill in the missing information. No one's connected the dots for them. No one's highlighted areas of concern. or shared ways of tackling those problems. So they've had no real impact on the business. But once you've got the right set of management accounts, these can be used to turn over stones and dig into things that aren't right. Constantly looking for 1% small improvements and allowing you to then make decisions on your pricing, staffing and your investments. So back to our 4-point action plan. Now we've got a good set of management accounts, then we need to look at what's going to be stopping you. Now where most business owners go wrong, they focus too much on cutting costs, spending too much time looking at their overheads and trying to save £5 on a monthly phone bill. The problem is that effort often outweighs the gain and your time is more valuable than that. What you should be focusing on is on the growth of the business, looking for profit improvement and ways to tackle that 28% increase in turnover needed. The easy maths here is that anything you add on your top line, whilst maintaining stability on everything else, is a straight line bottom increase. Now, we're not saying just go and increase your prices, but look at a range of different ways in order to tackle that turnover, finding the right balance for your business. Then there's the issue of time. So as a business owner, I can relate. We spend our time focusing on the daily operations of the business, and so it's hard to find the time for that financial analysis and strategic planning. But here's the thing, if your house was on fire, you'd find the time to deal with it, right? And if you've got the wrong accountant, well, then you've effectively lost your smoke alarm. So some of you might be thinking, do I even have a problem? You're not aware. That's okay, we're here to help. But some of you might be thinking, I don't have a business, so there's no fire to put out. I'm a landlord with only 1 or 2 properties, currently below the make detached digital threshold, but I've heard that a limited company is good for my rental properties. So now I'm going to move on to recent tax changes, voluntary wealth tax, and simple planning. So from April 2026, we've seen dividend tax rate increase by 2%. So for example, someone who's taken a salary and dividends up to 100,000, they're going to pay an extra £1,800 per year. Then from April 2027, landlords will be hit by the same 2% increase. So rental profits of £20,000, you'll see an extra £400 of tax. Then there's inheritance tax. Now I call this a voluntary wealth tax because with good planning, you might be able to reduce the amount you pay. From April 2026, business property relief is being restricted. Now, this name is slightly misleading because the word property shouldn't really be there. It's more business asset or business relief. So it's no longer all going to be inheritance tax free. Businesses under 2.5 million will pay no tax bill, but the element that goes above 2.5 million will pay effectively 20% tax in inheritance tax. Then April 2027, pensions will form part of your chargeable estate. So hands up, who here is worried about inheritance tax? So just to get an idea, roughly 43% of landlords in London or South East Kent will face a large inheritance tax bill without any planning. So the common concerns we see from our clients is how much will my inheritance tax bill actually be? Will my family have to sell the house? Can't I just give it all away? And my estate's too complicated for my family to understand. So if we take an example where we've got a home, money, pensions, savings in the bank, a business of £1.5 million, making a total estate 2.75 billion. Now, the key thing here is the business will be covered by business property relief. So when we've got our estate value, before the inheritance tax, will be nothing to pay, which is good news. But from April 2027, because of pensions falling in the state, that will go up to £240,000 worth of tax. But what if your estate is mostly made up of property? So we've got the same numbers here, but this time we'll replace the business with a property. And now no business property relief is available. It's the same estate value, but the potential inheritance tax would be previously £454,000. That will go up to a whopping £840,000. And the problem is that it only gets worse with increasing property prices. So at A4G, we first need to look at simple wins, the easy things that you can do first. Then we look at more bespoke tax planning from there. But the key thing is that we don't do dodgy tax planning. The problem we come across is where parents might want to look at gifting property to their children, but still having access to that income. So I'll come on to this, but we've got to go on a little side quest, and first we'll talk about the different property structures, the reasons why you might have those structures, and then answering the most frequently asked questions. So the four main structures we have is personal ownership, where you're going to pay tax on the profits yourself personally. You might have a HMRC registered partnership, where the partners pay the tax on the profits. A limited company, which will pay corporation tax. Then there will be any dividend tax on any money drawn from the company, or a limited liability partnership, which is similar to partnership. This time the members will pay tax on their profits. Now, there's three different reasons for why you might pick one of these structures. If you've got high level of income plus high lending, you might be restricted by the amount of tax relief you can get. Then it also depends on how much you want to draw from a limited company. Because if you're drawing all the profits out, you might pay more in tax. I will explain that in a little while. Then also your long-term plans. Because if you're looking at selling your property, then you want to draw money out from the company, you might pay two sets of tax. So why would you put property in a limited company? Well, your mortgage costs are usually going to be your biggest annual cost. And the property gurus of the internet will claim that everyone needs a limited company because of the dreaded Section 24 mortgage cost restrictions. Now, I'm going to assume that everyone has a good understanding of what those restrictions are, but if you don't, I'll have to explain it later at the barbecue. But if we now look at the tax rate that you'll pay personally versus a limited company, this is why you might want to put your profits into a limited company. So for reference here, I'm comparing a high rate taxpayer personally versus profits that we tax at 19%. And in a limited company, you can get the full tax relief from your mortgage payments, whereas personally, you're going to be restricted to basic rate. Then if your profits are retained within the limited company, you're not going to pay any further tax, because you only pay tax if you look at drawing that money out from the business. So any money you look to draw out from the business will be taxed at those dividend rates on screen there. Now, don't worry if I lose you on this next slide, but we do have to work out the effective rate of tax, because if we've got profits of £100 and you pay corporation tax at 19%, you're going to then be left with profits available of £81. If that's then taxed at your high rate dividend tax, you're going to pay 28.96%. Now, if we add the tax on your drawings to the tax you pay in a limited company, from drawing those profits out, well now, if you're drawing everything, you might pay more tax in a limited company than you would personally. A few things to note about limited companies: there's also no tax-free allowances. Everything is immediately taxed at 19%, and the highest rate of tax you might pay in a limited company is 26.5%. Now, the reason for the 26.5% is because businesses with profits below 50,000 will pay 19%. Larger businesses will pay 25%, then anyone who's in between those two rates will pay 26.5%. Now, the 26.5% is there to gradually bring the 19% up to 25%. So some people think, I'll just set up another limited company and get another 50,000 at 19%. But HMRC have associated company rules that prevent you from doing that. Now, if you're considering selling your property, you're going to pay capital gains tax on the increase between your purchase price and your sale price. So if you sell a property in a limited company versus personally, the tax rates are not too different. But if you sold the property and want to take that money out, we've got a tax on drawings again. And again, it might be more tax efficient to have your property in your personal name. So some people say, can I move all my properties into a limited company? Now, the short answer is, it is possible to move all your personal properties into a limited company, but the problem is that company is its own separate legal entity. So that means that to transfer the properties in, you're going to pay capital gains tax on selling the properties to the limited company, and then the limited company is going to pay stamp duty land tax on purchasing those properties. And that often outweighs the benefit of trying to transfer your properties. There is something called incorporation relief, which is designed to delay the taxes. You have to prove that you're doing more than a normal landlord would be doing, and show that you'll have a full trading business existing. You also have to make sure you have other commercial reasons other than just trying to avoid Section 24. Since April 2026, HMRC have become more stricter on this. So you now have to make a claim, see if it's successful, or be prepared to pay the tax. So why wouldn't you put property in a limited company? Well, if you're a basic rate taxpayer, or you've got no mortgage on your properties, then Section 24 doesn't apply to you. And if you're looking at drawing everything out from the limited company, you're effectively going to overpay a tax. There is also something called ATED. Now, when I say ATED, I'm not talking about ideas that are worth sharing, or a nice soft cuddly telly. What I am talking about is annual tax on envelope dwellings. Now, this is a potential tax charge that you might have to pay a residential property within a limited company that's worth more than £500,000. So some clients of mine will say, can I put my home in a limited company? And because of this, I strongly recommend against it. So alternatively, why might you put your properties in an LLP? So we said earlier, this is where we want parents wanting to give their properties while still having access to the income. So what we look to do with a family investment LLP, with the property portfolio in the parent's name, we put that into an LLP. We then bring the children in as members of the LLP. Now, the next thing is you need a solicitor to draw up a very good partnership agreement, and you need an accountant that fully understands how to account for LLPs. And what that does for you is absolutely nothing today. But what it will do is it will save you inheritance tax in the future. With the aim of looking at freezing your estate value, passing the increasing property values over to your children tax-free over time, whilst you still have access to some or all of the income. There is additional further planning you can do from there to reduce your inheritance tax estate, but I won't be covering that today. But finally, I'm going to move on to talking about selling or buying businesses. Because for any business owners that are looking at selling their business and focusing more on their property portfolios, the good news is that there's still an active market out there for buying businesses. And at A4G, we've helped sell more businesses in the last 5 years than we have in the 25 years before that. So when we look at businesses preparing for a sale, these are the 5 most common issues we come across. The key one I want to focus on today is the over-reliance on the directors or the owners of the business. So you need to ask yourself, if the business is highly dependent on you for all of the sales of the business, all of the operations, and managing all of the finances, then you're effectively going to be irreplaceable from the business, so it's either going to not be sellable, or you're going to be tied in and working for the devil for longer. So whilst you're trying to spend one day on the golf course, if you're constantly unable to take that day off, or making calls to check in on your team, because you have no confidence or trust in them, this is where A4G have experience. Because our founder, Malcolm Palmer, before he started his gradual retirement, he took the business through 30 years of growth, recruiting school leavers every year, and that's how I started 15 years ago. But he's written a book called Making Your Business Less Dependent on You. We've got feedback forms. If you complete one of the feedback forms, we'll give you a free book for this. If that book's not relevant for you, Malcolm's releasing a new book next month called The Secret Mindset of Top Estate Agents, which has been co-written with 2 Olympic athletes Roger Black and Steve Backley and Roger Black. How A4G can help is we can look at assessing the problem, setting out a strategy to help reduce your dependence on the business, and also maximising your business value for sale. We also hold our own events, such as making business dependent on you and the family estate planning, with our next event planned for the 9th of September. So if you're interested in any of those events, please do come speak to me or my colleague Amanda about those or anything else I've spoken about. But the key thing I want to leave you with is remember it's a 28% increase just to stand still. If you'd like to receive regular advice from us, please do sign up to our newsletter. And thank you very much for listening.